All right. So as a UPSC aspirant, I know you're always trying to understand the things that are shaping the Indian economy. You kind of get your head around all the factors, all the different dynamics, right?
Yeah, absolutely.
And today we're going to take a really close look at this really important development, one that, have big implications for all sorts of things. Everything from how people spend their money to, the stability of the financial system.
Hmm.
And that's the pretty significant rise we've been seeing in household debt.
Right. And for this deep dive, we're going to be leaning on a really solid analysis from the Indian Express. They've done some really thorough work charting this surge in household debt in India and mainly kind of focusing on the period after the pandemic hit. So roughly from around June 2021 to June 2024.
Okay, so that time frame really helps us, kind of pinpoint when this all started ramping up. So the big question we're tackling today, and this should be like front and center as you're preparing for your UPSC mains exams, is this jump in household debt just a temporary thing, maybe a rebound effect after everything got disrupted by the pandemic, or is it a sign of something deeper, something more structural, like some weaknesses embedded in the economy?
Yeah. And to make things even more interesting, the IE article even asks, like, straight up, is high household debt holding back private consumption right now? Which gets us thinking about that whole twin balance sheet problem we've talked about before. So yeah, is this a blip or is this something systemic, something that needs our serious attention?
Right. It's like trying to figure out if this is just a passing cloud or if we're talking about like a shift in the whole climate.
Yeah.
Right. So that's the vital distinction we're going to try to make. And throughout this discussion, we're going to try to unpack just how big this debt increase really is, try to trace where this borrowed money is actually going, and then really think critically about the difference between taking on debt for consumption versus using it to make actual investments.
Yeah, and we'll also look at some early signs that, maybe households are having a bit of trouble paying back these loans. And finally, we'll break down the Reserve Bank of India's policy responses and, the kind of tricky situation they're in trying to manage all of this.
Exactly. We want to give you, as a future administrator, the insights and context you need to really form your own well-informed opinions on this crucial part of the Indian economy.
Absolutely.
Okay, so let's just dive right in.
Let's do it.
The first thing that really jumps out from the Indian Express analysis is, just how massive this jump in household debt has been.
Oh, for sure. The numbers are kind of alarming, actually. Household debt as a percentage of GDP, it shot up from 36.6% in June 2021 to a pretty striking 42.9% by June 2024.
Wow, that was a big leap.
Right. And to really get why this is a big deal for you as you're building your understanding for the UPSC, you've got to remember that the average during the pre-pandemic years, from 2015 to 2019 was way lower, around 33%.
Yeah.
So this isn't just like a little wobble. We're talking about a substantial reshaping of household balance sheets here. It's a huge deal.
Yeah.
So the key takeaway is this. This isn't just a small uptick. It's a total shift. And what it means is that a bigger chunk of future household income is already spoken for. It's going to go towards paying off debt.
That makes a lot of sense. And what's really interesting, and this is important for understanding, social and economic trends, is that this increase, it's not limited to just one particular group, like one age group or income level. The article makes it clear that this credit expansion after COVID has been widespread. It's touched households across the board, in all different income brackets. So that tells me we're looking at something that's pretty pervasive, driven by probably a bunch of underlying factors.
Yeah, that's a crucial point. It suggests there's a whole bunch of things happening all at once, influencing how people are borrowing money across the entire economic spectrum. So now let's dig into where this credit is actually flowing. The Indian Express article lists out some pretty telling growth percentages for different lending institutions between March 2021 and March 2024.
Right. So personal loans from regular banks saw like a massive 75% growth. Then retail credit from NBFCs, non-banking financial companies and HFCs or housing finance companies, those also expanded a lot, around 70%. And even loans from those microfinance institutions, they saw a significant increase, like 67%. So we're not talking about small incremental changes here. This is rapid acceleration.
Absolutely. And to really get the full picture, we need to compare these growth rates to the growth in household disposable income, which is about 43%, and private final consumption expenditure, which grew by about 49% during that same period. So the difference is really important for your analysis. Borrowing has been increasing way faster than people's actual earnings.
Yeah, it's like incomes are on a little scooter while borrowing is in a sports car.
Right.
So that brings us to this really interesting what-if scenario that the article presents. It basically says that if this whole debt surge hadn't happened, if household borrowing had just stuck to its usual patterns, then private consumption could have been about 2 percentage points of GDP lower. Or The other option is that households would have had to make some really drastic cuts to their savings. So basically, if borrowing hadn't gone up, the government might have had to step in with more direct spending to keep consumption levels up. It's something to keep in mind as you're thinking about policy choices.
Definitely. It really highlights how important this increased borrowing has been in keeping consumption going after the pandemic. But as the article points out, it also means that household incomes haven't kept up with the level of spending we've seen. So what's happening is households are relying more and more on debt just to keep up their spending and saving habits.
So they're essentially using debt to maintain their lifestyle.
Got it.
Got it. So borrowing itself isn't necessarily a bad thing, right? The article makes that point. But here's where things get really interesting. And this is where you need to put on your analytical hat as a UPSC aspirant, really sharpen your focus. The article raises some serious concerns about the type of borrowing that's happening. Specifically, they're saying that it looks like a bigger chunk of this borrowing is going towards immediate consumption, spending on things right now, rather than long-term investments.
Yeah, and that's a crucial difference when we're thinking about whether this trend can actually last in the long run. Borrowing to invest in something like starting a business or buying an asset that'll make you money in the future that has a totally different long-term effect than just borrowing to buy things you want right now. And the article points out that there's been a huge increase in unsecured loans between March 2021 and March 2024.
Okay, so unsecured meaning no collateral.
Right.
So tell me more about that.
Exactly. So unsecured loans. And those portfolios at banks have grown by a huge 82%. And for MBFCs, that growth was even bigger, around 130%. So those are really big jumps in borrowing that aren't backed by any actual assets, like a house or a car.
Right. So it's like borrowing on a promise rather than something tangible. Okay.
Yeah. And the Indian Express connects this to income levels. They point to RBI data that shows these unsecured loans are way more common among people making less than 5 lakh rupees a year. It seems like this part of the population really leaned on credit to keep spending during that recovery period after the pandemic. On the flip side, wealthier borrowers, while they also took on debt, they were more likely to use it to buy assets like houses and cars. So it's almost like two different stories playing out.
So essentially, it seems like a lot of households are borrowing just to keep up with their current lifestyle instead of investing in something that will help them grow financially in the future. It's a really important difference to remember when you're analyzing long-term economic trends.
Exactly. Two very different approaches.
Right. So we're seeing this trend where a big chunk of this debt, particularly for lower income groups, it's going towards spending today rather than building for tomorrow. And that brings us to a really important question, and this is key to understanding economic vulnerabilities. Are there any signs out there suggesting that this borrowing spree is starting to cause problems for people? Are there any red flags?
Unfortunately, yeah, there are. The article highlights a few data points that suggest people are getting deeper into debt, and it might be getting harder for them to pay it all back. For instance, RBI figures show that a pretty worrying 11% of borrowers who have personal loans under 50,000 rupees, they've got loans that are overdue. So the fact that even these small loans are having repayment issues, that should be a big warning sign for you as you analyze household financial health.
Yeah, that's a lot of people struggling, especially when we're talking about those smaller loan amounts. It's like even making those smaller payments is becoming tough for a decent chunk of borrowers.
It is. And to make things even more complicated, the article points out that in the second quarter of the fiscal year 2024-25, almost 3 out of every 5 personal loan customers had more than 3 active loans at the same time. So you can picture it, right? People juggling multiple loans, which can make managing debt a total nightmare and really increases the risk of getting too deep in the hole.
Right. It's like trying to keep all those plates spinning in the air.
Exactly.
And it's not just banks and NBFCs either. The article says that even in the microfinance world, almost 6% of borrowers were taking loans from 4 or more different lenders as of September 2024.
Wow.
I mean, that sounds like a pretty clear sign that some people are having a hard time making ends meet and might be getting stuck in a debt cycle.
Yeah, it definitely raises some red flags. So all of this increased borrowing, it leads to one unavoidable consequence. A bigger share of people's income will have to go towards just paying off those loans. And if income growth stays low, like the Indian Express says it will, then those loan payments can really eat into the money people have left over to spend or save. And that can end up slowing down the whole economy.
It's like that loan repayment becomes this big anchor weighing down future spending. Right?
Exactly.
And we're already starting to see some early signs of this repayment pressure showing up as rising delinquencies, right?
That's right. The article mentions an upward trend in overdue loans, the ones that are more than 90 days past due for NBFCs. And we're also seeing more delinquencies in gold loans. And there's growing concern about the quality of assets in personal and consumer finance and in vehicle loans, too. And something worth noting for microfinance institutions, loans that are overdue for a shorter time between 31 and 180 days, those have seen a big jump too.
So that's a lot of different areas showing signs of stress.
It is, and it really makes you think about the bigger picture. What does this rise in overdue payments tell us about how resilient the financial system is and how healthy household finances are? It's not looking good right now. It could mean a buildup of systemic risk.
Right, so those are some serious concerns. Then the Indian Express mentions that banks have been steadily writing off unsecured retail loans. And I'm guessing that's not something they do lightly. It usually means they don't think they're going to be able to get that money back. Right?
Exactly. It's a sign that things are not looking good in terms of asset quality for that particular type of lending.
Okay, so now we need to talk about the Reserve Bank of India and how they've been responding to this whole situation. Yeah. I mean, they're the ones at the helm trying to steer the ship.
Right.
So the article points out that the RBI did step in back in November 2023. They were trying to slow down this rapid credit expansion by increasing what are called risk weights for certain types of loans. Can you explain what that means and why they did that?
Sure. So basically, increasing risk weights means banks have to set aside more capital, more money to cover potential losses for certain types of loans. In this case, they were targeting lending to NBFCs and unsecured consumer credit. And the goal was to make these loans less attractive to banks, from a business standpoint. So it's kind of like a gentle nudge from the RBI to encourage banks to be a bit more careful about lending in areas that might be a bit risky. They're not outright banning anything, but they're trying to manage the overall growth in these potentially shaky parts of the credit market.
So it's like a subtle way to tap the brakes on lending in certain areas. Got it. But then the Indian Express says that the RBI partially reversed course on this policy. Why did they do that?
Well, it looks like they made this change because the economy was clearly slowing down. And they were also getting feedback from businesses, India Inc., that consumption was weakening. So it seems like the RBI thought maybe they tightened things up a bit too much and needed to ease up a bit.
Okay, so they were responding to real-time changes in the economic landscape. So they loosened things up to try and get the economy moving again.
Yeah.
But it makes me wonder, is the RBI's thinking that the slowdown is mainly due to their policies? Is that the whole story? Or could there be other factors at play, like global economic conditions or deeper structural issues within India? This is where we need to really think critically.
Right. It's a complex situation for sure.
It is. So tell me about their current approach.
So as the article explains, the RBI's plan now involves rolling back some of those risk weight increases. They're also thinking about cutting those policy interest rates maybe by as much as 50 basis points soon, and maybe a total of 100 basis points over the whole cycle. And they're looking at ways to inject more liquidity into the financial system. Basically, they're trying to make it easier and cheaper to borrow money.
So the idea is to encourage more borrowing to boost spending and give the economy a jolt. But the Indian Express raises a really important question. Given that household debt is already so high and incomes aren't growing very fast, can we really expect people to take on even more debt to fuel their spending? I mean, they still have to pay back what they've already borrowed, right?
Yeah, that's the big question. And without some serious and consistent income growth, it's going to be a tough challenge for households to manage.
Right. It's like telling someone who's already carrying a heavy load to just pick up another one.
Exactly. And we also have to consider whether lenders are going to be so willing to keep giving out loans to households that are already showing signs of struggling financially. The article gives some really important context on how much of lenders' portfolios are made up of personal loans.
Yeah, so as of January 2025, personal loans made up about a third of all the credit given out by banks. That's more than the credit extended to big sectors like services industry, even agriculture individually. And for NBFCs and HFCs, retail loans make up over half of their total loan books. So that's a huge chunk of their business. That really shows how intertwined household debt is with the entire financial system.
It really does. And with all these delinquencies and worries about asset quality, lenders might start being more careful about giving out more credit, even if the RBI is trying to make it easier to borrow money. So this leads to the main point that the Indian Express makes in their analysis,
which is that this whole surge in household debt isn't just some isolated thing happening in a vacuum. It's a symptom of bigger, more fundamental problems facing the Indian economy. And this is a key insight for your UPSC mains prep.
Exactly. They're arguing that the real culprits here are not enough jobs being created and incomes not growing fast enough. So the right way to fix this isn't just by tweaking monetary policy, messing with interest rates and stuff. We need to address those root causes.
So it's like treating the underlying illness, not just the symptoms. Okay, so let's do a quick recap of the main points here for you as you're preparing for your UPSC exams. We've seen a huge increase in household debt since the pandemic, and it's affecting people across all income levels. A big chunk of this borrowing is going towards spending rather than investing, and it's often through unsecured loans, especially for lower income folks. We're also seeing some worrying signs that people are having trouble repaying their loans and delinquency rates are going up. The RBI tried to put on the brakes at first, but now they're trying to stimulate the economy by making borrowing easier. The problem is it's not clear if that'll work because people are already in a lot of debt and their incomes aren't growing much. And ultimately, this whole debt situation, it's tied to bigger structural problems of the economy like not enough jobs and weak income growth.
Absolutely. So as you continue your UPSC prep, it's so important to really grasp this whole dynamic. It touches on all these crucial parts of the Indian economy: consumption patterns, financial stability, the RBI's role, and how those structural factors can really impact economic growth. Think about how this might affect future decisions about government spending, financial sector reforms, and even social welfare programs.
Yeah, these are all interconnected,
Yeah.
and we need to see the bigger picture. So given everything we've discussed, what do you think is the best way to get the economy growing strongly without making those household financial problems even worse? Is the government's current focus enough, or do we need some more fundamental changes to tackle those root problems of low incomes and not enough jobs? These are the big questions you should be thinking about as you study for your exams.
I hope this deep dive into household debt, using that excellent analysis from the Indian Express, has given you some food for thought for your UPSC preparation. And if you found this discussion helpful, please do hit that like button and subscribe for more in-depth analyses on topics that are relevant to you. And we love hearing from you, so please share your thoughts or any questions you have in the comments below. We're always looking for areas where we can provide even more helpful insights.
Absolutely. And just a reminder that all of this is based on the great reporting from the Indian Express. So check out their article for even more detail.
Absolutely.
All right, thanks for joining us, and see you in the next deep dive.
See you then.